Are you tired of watching your portfolio underperform the market's average return while other investors keep picking the right stocks and outperform everyone else? What if I told you you're just a few steps away from achieving those great returns just by following the simple steps I'll cover in this video? If you don't believe me, I've included clips throughout the video of super investors explaining these concepts. So let's get into it. The first step to picking the right stocks is well known among investors, but most people either overlook it or struggle to find it, and that's the moat. Here's super investor Bill Ackman explaining it.
Is you get to a certain scale and you do it successfully, and the brand is now in the understood by the consumer. And what's interesting about Chipotle is what they've achieved is difficult, right? They're not buying frozen hamburgers getting shipped in. They're buying fresh, sustainably sourced ingredients. They're preparing food in the store. That was a first, right? The quality of the product at Chipotle is incredible. It's the highest quality food you can get for. You can get a serious dinner for under $20 and eat really healthfully and very high quality ingredients. And that's just not available anywhere else. And it's very hard to replicate and to build those relationships with, farmers around the country. It's a lot easier to make a deal with one of the big, massive food producers and buy your pork from them than to buy from a whole bunch of farmers around the country. And so that is a big moat for Chipotle, very difficult to replicate.
So basically, a moat is a company's lasting advantage that keeps competitors from taking its market share. Just like a castle is protected by a moat, businesses use certain strengths to stay ahead. Some companies have a strong brand like Apple or Coca-Cola that makes customers choose them over others. Other benefits from the network effect, where the more people use a product, the more valuable it becomes. Think Facebook or eBay. A cost advantage allows businesses like Walmart to keep prices lower than competitors, making it hard for others to compete. Some companies create high switching costs, meaning customers find it difficult or expensive to leave, like software that locks users into an ecosystem. Patents and unique assets like exclusive technology or pharmaceutical formulas also act as moats by preventing others from copying their products. Finally, some industries naturally have efficient scale where only a few big players can survive, such as utilities or railroads. When a business has a wide moat, it means it can defend itself from competitors and keep making money for years. The next step is just as important, though slightly off topic: thinking in reverse or inverting, a concept Zoom investor Charlie Munger emphasizes.
No, there are all kinds of tricks that I just got into by accident in life. One, I invert all the time. And when I was a weather forecaster when I was in the Air Corps. And how did I handle my new assignment? Being a weather forecaster in the Air Corps is a lot like being a doctor that reads X-rays. It's a pretty solitary.
Yeah.
You're in the hangar in the middle of the night and drawing weather maps and you're calling pilots, but you're not interfacing with a bunch of your fellow men very much. And so I figured out the minute I was actually making weather forecasts for real pilots, I said, how can I kill these pilots? Now, that's not the question that most people would ask, but I want to know what the easiest way to kill them would be so I could avoid it. And so I thought it through in reverse that way. And I finally figured out, I said, there are only two ways I'm ever going to, I was in the ferry command, there are only two ways I'm going to kill a pilot. So I'm going to get him at icing his plane can't handle, and that will kill him. Or I'm going to get him someplace where he's going to run out of gas before he can land because all the airports are sucked in.
To think like Charlie Munger, invert the idea of, for example, a moat. Instead of asking what gives a company an advantage, ask what could destroy that advantage. For example, a strong brand like Apple is a moat, but what if customers lost trust in it? That would weaken the company fast. The same applies for other moats. Network effects break if users leave, cost advantages disappear if competitors find cheaper methods, and patents lose value if new tech replaces them. By looking at what could go wrong, you see weaknesses before they become threats. That's how you truly understand a company's strengths. The first step is crucial for picking stocks, yet many investors overlook it, having both a story and the numbers to support your investment thesis, a concept Charlie Munger discussed in his 1994 lecture titled A Lesson on Elementary Worldly Wisdom. Charlie Munger highlighted the necessity of a multidisciplinary approach to investing. He argued that understanding various mental models from different disciplines allows investors to construct a comprehensive narrative about business, which, when combined with numbers, leads to a more informed decision making. And Warren Buffett, influenced by Munger, shifted from a purely number based cigar butt investing approach to one that values the quality aspect of a business. This evolution underscores the significance of understanding a company's story, its competitive advantages, management quality, and growth prospects, alongside its financial metrics. So basically, the idea is simple. Great investors like Warren Buffett and Charlie Munger believes you need both a story and numbers to make smart investments. The story is about understanding the business, its competitive edge, management, and potential to grow. The numbers are about the financials, looking at earnings, debt, and how the company is performing. You need both. The story helps you understand what the company is trying to do, while the numbers tell you if it's a good deal. Combining these two gives you a complete picture and helps make better investment choices. This next step is very important to keep in mind when looking at stocks. Taking your time. Here's Charlie Munger talking about it.
He had the attitude, having come out to Iowa when the land was not much more than $1 an acre, and having stayed there until that black topsoil created a modern, rich civilization and some of the best land in the world. His attitude was that in a favored life like his, when you were located in the right place, you just got a few opportunities if you lived to be about 90. And the trick in coming out well was seizing a few opportunities that were your fair share that came along when they did. And he told that story over and over again to the grandchildren who hung around him all summer. And my mother, who had no interest in money, remembered the story and told it to me. But I'm not my mother's natural imitator. And I knew Grandpa Hingham was right. And so I always knew from the very first, when I was a little boy, that the opportunities that were important that were going to come to me were few. And that the trick was to prepare myself for seizing the few that came.
Basically, you want to take your time in researching and not rush the process. This way, you can truly understand the business, its potential upsides and downsides, which will help you become more confident in your investment thesis. It will also help you doubt less, meaning you can hold the stock through tough times. On top of this, you'll realize that not every investment is a good one, and when you do find a great opportunity, you'll feel more comfortable betting big on it. This last step is the easiest in theory, but for most people, it's very difficult. Here's Warren Buffett explaining it.
I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding.
What Buffett said here is that we need to hold these high quality companies almost forever. When we find good opportunities, we shouldn't sell them because of short term market fluctuations. We want to hold them long term, as selling too early could mean missing out on great profits. Now, knowing when to sell comes down to a few things. First, if we need the money. Second, if the stock has become too expensive that it's unlikely to deliver strong results in the future. And third, if we can find better returns elsewhere. Thank you so much for watching. Now, if you want to learn about a few stocks that these super investors are buying, check out this video right here.